What an incredible day we just had in the market. Every single company is up in the green and very significantly on the news that tariffs are going to be paused, and we can see the Mag 7 themselves ending the day, every single one up double digits. And the way the day unfolded, we were in fact up around 1% before any news was released. Then the president in fact announced a 90-day tariff pause, and we ended the day adding $4 trillion to the market, which was, as we will come to show you, one of the best days since 2001. Now we also got to see the semiconductor rally, and rally strong it did. Even advanced micro devices, which actually didn't rally that strong over the last few days on some good announcements, up 24%. That is a very significant increase. Nvidia up 19% as well, with also Tesla, one we want to highlight, up 23%. So all in all, a very strong day. And whilst we open the day in fact with sentiment very low in extreme fear around the 3-point, it is starting to get a little bit better, now sitting at 16. But do bear in mind, we are still in a bearish sentiment space, and any news that does come out could swing the market one way or another, something we have just seen. Now we also want to be clear, it is very hard to see which way the market is going to go after yesterday's large increase. The pre-market showing us we're going into a bit of a slump, with stocks down 3 to 4 percentage points, and that also includes the Mag 7, which did have a very strong day. So we would just say perhaps a bottom is not in, and that we should always stick to our own strategy, whether that's dollar cost average or any other method. And as we've said, news does move very quickly. When we did record the episode yesterday, just after publishing it, we got news that China announcing 84% retaliatory tariffs on US goods, which shows us now there is clear escalation from both the US and China, and that a global trade war between the two large countries is something that does look to be likely. And we even heard the President Donald Trump tweet that this is a great time to buy stocks. This was literally just before we did get the massive pump, and just before we did hear any announcement of in fact a 90-day pause. And evidence does show us when a president says it is a great time to buy, we should pretty much listen to them, and it has previously called a bottom. In fact, when we look at President Obama, he made a call in March 2009. This was where stocks had lost a significant amount, nearly 40%, the financial crisis of 07-08, and just 3 days in fact before the market did bottom, President Obama did say what you're now seeing is profit and earnings ratios are starting to get to a point where buying stocks is potentially a good deal if you've got a long-term perspective on it. So perhaps we should have seen this coming. And the tweet that did in fact pump the market from Donald Trump goes on to say that based on the lack of respect that China has shown to the world's markets, I am hereby raising the tariff charge to China by the United States of America to 125%. This is effective immediately, and we can see here this is the continuation of the escalation of tensions between China and the US. And he says at some point, hopefully in the near future, China will realize that the days of ripping off the USA and other countries is no longer sustainable or acceptable. So it is very clear, especially from the last few days, especially from the tweets that Trump has been putting out, that his issue does in fact lie with China. And then he goes on to say that conversely, and based on the fact that more than 75 countries have called representatives of the US, including the Department of Commerce, Treasury, and the USTR, to negotiate a solution to the subjects being discussed relative to the trade barriers, tariffs, currency manipulation, and non-monetary tariffs, and that these countries have not, at my strong suggestion, retaliated in any way, shape, or form against the United States. I have authorized a 90-day pause and a substantially lower reciprocal tariff during this period of 10%, and that is effective immediately. So in conclusion from this tweet, we have the escalation of tensions with China. The retaliatory tariffs now sit at 125%, and he's put pretty much a blanket rule on the vast majority of trade partners, sitting at 10% effective immediately, with a 90-day pause to have negotiations, which he does ultimately believe is going to be very successful for the US. And after this news, the Nasdaq, as we can see here, climbed more than 12%. That is the second best day it's ever had. In fact, you'd have to go to 2001 to see a day in the markets that was a lot higher. And Apple, which has also suffered in these tariff talks, as they do have a lot of manufacturing in China, also had their best day since 1998, rallying 15%. And remember this graphic that we have showed you, 7 of the 10 best days take place in the bear markets, and 2020, the second best day, happened immediately after the second worst day. So perhaps this isn't something we should be surprised about in terms of the reaction. Granted, maybe not a lot of people did see this tariff pause coming, and we can see here the graph, in fact, just over the last few days, the Dow Industrial, S&P and the Nasdaq all bouncing very strongly on this news. But as we've highlighted, we're already seeing now in the pre-market a lot of these companies start to fall. Whether or not this will erase yesterday's gain is something that we don't know, but again, very possible. Markets have been incredibly volatile and we had entered into a bear market. And it wasn't just the US markets, in fact, European stocks also up nearly 5% as traders get a bit of respite, as we can see from the massive sell-offs we have noted just over the last few days. And if you remember, we've been talking a lot about recession. In fact, Goldman Sachs increased their expectations of a recession to 45%. This was the second hike they had done in just a matter of days. Well, now, and in fact immediately after the news of the pause, they have rescinded this and don't believe a recession is likely. Again, markets move very quickly, as well as global expectations. And we can see here, in fact, Bessent, who is the US Treasury Secretary, says that Trump can likely reach tariff deals with US allies, something we're starting to see now on a day-to-day basis. We have the EU, in fact, here welcoming Trump's tariff pause and offering again a 0-for-0 deal. So it is looking likely that, in fact, we will start to get a lot of positive news on at least the trade partners, where in fact this 10% has been put on, where in fact a trade pause has been welcomed. And we can also see here, in fact, Vietnam also welcoming this and starting to have negotiations. Don't be surprised if we see a lot more coming to light, as many of these are probably going on behind closed doors. And if you remember, not too long ago, again, this is more for a bit of humor, but every time that Bill Ackman has got frustrated, has got angry, and had some kind of tantrum, it did look like the market had bottomed. And it was just a few days ago we did bring this to your attention, where he did go on quite a significant rant about all of the issues that have been put in place by the tariffs. And after now we see that pause, he actually went on to tweet Donald Trump and say thank you on behalf of all Americans. And we have to remember that a lot of his portfolio has been affected. In fact, he did continually buy Nike just over the previous quarters, making up around 11% of his portfolio. And we can see that rebounded very rapidly, around 11% after the news. So of course he is going to be happy. In fact, his portfolio in total is just under $13 billion. Something maybe we'll see from more super investors. Maybe we'll even get a glimmer into Warren Buffett soon about what he is buying. In fact, maybe even Nancy Pelosi. A lot of these people that we do on this channel like to bring to your attention, so make sure you are subscribed. Now, we also want to highlight that actually earnings season is right around the corner. In just a matter of days, we're going to have companies reporting their earnings, where we're going to hear some commentary as well about the expectations of how these tariffs are going to affect their company. Maybe we'll even get some revisions to guidance, whether or not in fact share prices do decrease on the basis of this, or we do see it already baked in given the significant drops we've seen over the last few days. Something to consider. But we're just going to flag a few of these companies today, our understanding of the valuation, whether we believe they are undervalued, reasonably valued, or overvalued. And we're going to start off with ASML, which is actually just reporting in a matter of days. As we can see, next Wednesday we will hear guidance as well as how they have performed in the latest quarter. And this company rocketed up 15% yesterday, but as we can see in the pre-market, like many, down more than 5%. They are still down 31% over the last year. Year to date, pretty much flat now, and over the last 10, still massive outperformance of the S&P, up 627%. Still trading near the lower end of the 52-week range, with a double buy from Seeking Alpha and Wall Street. And we can see, even after the 15% increase, their forward P at 26, still severely below the 5-year average of 33.9. So we would call this a severe undervaluation signal. And we can also note the yield on offer now, 0.92%, is marginally higher than the 5-year at 0.84, another possible undervaluation signal. We'll also highlight this other model where we look at the 5-year average P. We have the blue tunnel, which indicates the expected fair price. Ideally, we want to see this increase over time. That is what we want from our companies. But we also notice, even though it has started to increase slightly, still well below the lower end. That is disparity there, and again confirming that previous severe undervaluation note. Now, our intrinsic value gets to just over $1,000, something we have said for quite some time, and that is derived from the DCF model, where we have the free cash flow year on year, average growth 41% over the last 10. We've gone for 14, although bear in mind we have a low, medium and high. Numbers, as always here, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for ASML or any others. That based on 14% with a discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 1055, indicating 62% upside, and that is after the increase we did see yesterday. Now, we'll also show you for full transparency at the lower rate of 12%, 920, indicating 41% upside, and for those that believe it should be a lot higher at 16%, 1209, indicating 85. Now, we will show you at the midpoint of 14, which is what we typically do on this channel. We always like to add a margin of safety. Where we use 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at $950, then we keep going in essence until it's near the current trading price. And what you are getting right now, even after the increase, not 40% just yet, but at least 35, so somewhere 35 to 40 region, with Wall Street themselves seeing this at $933, in turn translating to 43% upside over the next year. As always though, give us your thoughts. 35 to 40% MOS, 43% upside. Is ASML maybe one you've been buying? Maybe it's on your watch list, or for whatever reason you don't believe it has a wide moat and doesn't fit your portfolio. Now, we're also going to show you, for those that believe we should be using the lower end at 12%, what is the margin of safety. Just to highlight, you are still getting quite a significant amount, which does indicate it is still fairly attractive, near the 30% point. So we're looking at 25 to 30% margin of safety. Wall Street, again, price target untouched at 43%. And for those that believe maybe we should be even lower, more conservative at 10%, this is even below our low expectations. You are still getting a margin of safety, as in fact we can show you near the 20% point, so at least 15, somewhere 15 to 20 region, again 43% upside. So 10% future free cash flows, you are still getting a fairly attractive margin of safety. But as always, give us your thoughts. ASML, buy, hold or sell. Now, before we move on, we just want to let you know we have released our latest free weekly article where we talk about 2 stocks we have been buying after the crash. We typically release one every single Monday morning to your inbox for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, and you'll also be able to gain access to 35 severely undervalued stocks for the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year, and another spreadsheet detailing 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to Tesla, which is in fact reporting over the next few weeks. They're up 54% over the last year. Year to date, still down 33%, even though they pumped up 23% just in one day, but down around 3% in the pre-market. Over the last 10 years, still massively outperforming the S&P, even after the roller coaster ride, up 1,874. Trading near the lower end of the 52-week range, still all analysts do consider this company a hold, and they trade for a forward valuation that you could argue is severely high at 106. Now, if we compare that to the sector, it does sit at 13.7, so you're paying a 672% premium, but we do want to point out, in terms of comparing it to its 5-year average, it does sit around 9% lower. No surprise then, in comparison to the sector, why it does get an F on valuation, although many investors will argue that you can't compare this to the sector, as it does have a lot of opportunity in other areas. Now, we're just going to show you our intrinsic value, which comes to $203. Now, this is effectively derived from the future free cash flows at a growth rate of 35%, which is very high for this industry. But again, if you believe they will massively benefit from robotaxis, Optimus robots, as well as many other areas related to artificial intelligence, then you could argue perhaps 35% may appear reasonable. But we want to highlight, even with 35%, that intrinsic value at $203 does give downside of 22%. You'd in fact need to see this company growing future free cash flow at 40% to see it as undervalued, and even that is only upside of 5%. So if you are someone who believes 40% to be more appropriate, again still you wouldn't be getting any margin of safety until $247. But as we want to use the medium rate to be consistent like we do in the majority of episodes, we do want to highlight that we see this right now trading at a premium, and if you wanted even a 10% MOS, you would need to wait below $200, 182 in fact, and Wall Street themselves, they still believe a lot of upside, $350 over the next year, translating to 35%, but as always, give us your thoughts below. Now we just want to reflect on Nvidia before we continue with companies reporting their earnings this month, as they are reporting a little bit later, but they had an incredible day, up 19%. Yes, a bit of a pullback in the pre-market. This could really go anyway. They could go further down, could in fact increase the great run of yesterday. Nonetheless, over the last year, up 34%. Year to date, they are still down around 15%. Massive outperformance, more than 20,000% over the last 10, trading now towards the midpoint of the 52-week range after the great run-up, with Wall Street calling this a strong buy, Seeking Alpha also a buy, and we can also show you even after the increase, forward P of 26 still significantly below their 5-year of 43, and still a massive severe undervaluation signal given that disparity. And one thing we do like is the fact that the expected price has been increasing over time, quite drastically as well, not something as you can see with many companies. And in terms of our intrinsic value, we still believe it to be $162. This is with a growth rate of 20% when over both the last 5 and the last 10 years, it has been at the triple digit rate. Again, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others, but based on our 20% growth rate moving forwards, you are still getting a large margin of safety, as in fact we do keep on going today at the price. You're getting nearer 35%, but pretty much around 30% at $114. Wall Street still, they're sticking with their guns. They see this price target 177, translating to 61% upside. And for those that want to see it at the lower end of 15%, when we do take a look at the margin of safety, you're pretty much getting around 5%. Again, market's very volatile. We could see it go even lower. We could see it continue to climb. But give us your thoughts. Were you buying Nvidia? Maybe one on your watch list, or for whatever reason, not one you want to consider. We then move on to Taiwan Semiconductor, one that was up 12% just yesterday, down only around 1% in the pre-market, but as we've highlighted before, a triple strong buy, incredibly rare on the channel, still trading towards the lower end of the 52-week range, up 9% over the last year, year to date still down 20%, and over the last 10, massive outperformance. We also notice still trading below the 5-year average, so severe undervaluation, and also undervaluation when we do reflect on this model, we can still see that disparity, and something we've only noticed in March 2025. Going back all the way over the last year, we can't see one point where we did get that disparity, where we did note that severe undervaluation, and we can still see, given our intrinsic value of $236, you are getting a very large margin of safety, as in fact we do keep on going today. You're not getting 40% just yet, you're getting near a 35%, with Wall Street themselves still very bullish with that triple strong buy rating, 245 over the next year, translating to 57% upside. But give us your thoughts. Maybe you believe with geopolitical tensions and a global trade war, you might need more than 35% for Taiwan Semiconductors. We then move on to Intel, which was up nearly 20% yesterday, down around 4% in the pre-market, down 44% over the last year, year to date up 7%, over the last 10, down 34%. So if you had invested in this 10 years ago, you would be down around 1/3 of that total investment, and it's trading towards the lower end of the 52-week range with just one buy rating from Seeking Alpha and a forward P around the 43 mark, which as we can see significantly above the sector median. You're paying a 122% premium, and also it is sitting above their own 5-year by around 51%. No surprise then why they do get a fairly poor D score. And our intrinsic value today at $26 does in fact come with a growth rate of 0%. However, we would say their free cash flow has been negative over the last few years. We have gone for an estimation for 2025 and beyond, so there is a lot of subjectivity in this estimation. At 0% though, we can in fact see $26 upside of 24% if you believe it will be higher, and that $9 billion is around the appropriate value, especially over the longer term. Then this could perhaps look like opportunity, but when we do run it through the margin of safety today, you're getting around 20%, with Wall Street themselves price target $25, upside of 19%, and we are due to hear from their earnings very soon. We then move on to Johnson & Johnson, which barely moved yesterday, although in the green, just under 1%, pretty much flat over the last year. Year to date, up only 4%. Over the last 10 years, up only 52, trading in the mid to lower end of the 52-week range. Double buy from Seeking Alpha and Wall Street, and we can see severe undervaluation, not only the forward P below at 14.3 versus 16.3, but the yield of 3.3 above their own 5-year at 2.75. And again, this is reflective when we take a look. There is some disparity, so you could argue possible severe undervaluation. Now, intrinsic value comes to $176, so you will get a nice margin of safety, as in fact we keep going, not 20% just yet. You're getting around 15% at the $150 mark. In terms of Wall Street, $172, 14% upside. They're also a dividend king, 50 plus years of consecutively increasing the dividend. Is this one then that does look like a good opportunity to buy, especially for those that maybe do want to use that dividend yield for their own expenses? We then move on to another dividend king, PepsiCo, which was up 4% yesterday, down although marginally in the pre-market, negative 15 over the last year. Year to date, down 4%. Over the last 10, up 52. Trading towards the lower end of the 52-week range. Just one buy rating from Seeking Alpha. And we also get one of the lowest forward valuations over the last 5 years, and quite significantly. And their yield is touching the 4% point. Again, we do get two very strong undervaluation signals. And we also notice not only is there disparity giving us severe undervaluation, but pretty much over the last 12 months, PepsiCo has been trading at a very large undervaluation. Now, our intrinsic value gets to $169, and as we look at the margin of safety today, you're not getting 20% just yet. In fact, it sits bang on 15%, and that is also the upside Wall Street see over the next year with a $166 price target. Give us your thoughts, buy, hold, or sell. We then move on to Waste Management, which was up 4% yesterday, down around 1% in the pre-market, up 9% over the last year. Year to date, up double-digit 11%. Over the last 10 years, outperforming the S&P, up 324%, trading in the upper end of the 52-week range with a double buy from both Seeking Alpha and Wall Street. And maybe for the first time today, in fact, we see their valuation above the 5-year, their yield below. So this is what we would call a double, perhaps overvaluation signal. And when we look at this model, it is pretty much sitting at the upper end. So again, reasonable valuation / slight overvaluation. And our intrinsic value comes to $227, near the current price. So we believe Waste Management right now trading around its fair value. Wall Street themselves see $246 price target, 11% upside. And if we were to use a margin of safety, if you wanted it at 10%, a buy at 205, at 20 around 182, and at 30 around 159. As always though, do let us know your thoughts. We then finally move on to Advanced Micro Devices, up 24% just yesterday, down although marginally 3% in comparison in the pre-market, down 43% over the last year. Year to date, down 20%. Over the last 10 though, massive outperformance, still trading in the lower end of the 52-week range. Double buy from Seeking Alpha and Wall Street with a forward valuation sitting just below 21, which when we take a look at it, only marginally above the sector at 6.3%, but significantly below their 5-year average, in fact by around 50%. And when we do deeper dives, we do typically show that their growth at an A and their profitability at an A- is very strong, massively above the sector. So they're growing and more profitable than the sector, but pretty much trading at the same level. This in turn, as well as lower than the 5-year average, does give us a lot of undervaluation signals. And our intrinsic value of $137 is derived using a growth rate of 25%. When we take a look at the margin of safety that is in fact applicable at this level, you are still getting at least 20%. In fact, at the 30% point at $96, it could perhaps be one to consider. At 35% around 89, perhaps we do go back down to that level given the pre-market. But 30 to 35%, Wall Street themselves very bullish, 147 price target, 58% upside. And we can also show you at the 20% what the MOS would be at $98 intrinsically. You wouldn't be getting 10% just yet, sitting somewhere between 5 to 10. Again, Wall Street see this at 58% upside. And as always, give us your thoughts below. Buy, hold, or sell. Don't forget as always to sign up to the free weekly newsletter. We're dropping a fresh copy Monday morning. Grab those spreadsheets, come and join us in the Patreon. And as always, have a great day. We'll see you all on the next one.